Hello and welcome to AgriFocus, the podcast from Agriland that takes a closer look at the issues that matter most to farmers across the country. I'm Frances MacDonald, and in this special episode on Budget 2025, I'm joined by Alison McHugh, tax partner with EY Ireland, and we're going to take a first look at some of the key announcements on Budget Day for farm families. Alison, overall, it was quite a generous budget.
Hi, Frances. Yes, indeed it was. There was a number of changes to tax credits, increase in standard rate band, reduction in USC, which obviously will benefit all taxpayers. And then in addition to that, there was obviously a number of targeted measures announced that will benefit farmers specifically, as well as then some changes around capital gains tax reliefs and CAT reliefs that equally will benefit those farmers who are looking to maybe transition their business down to the next generation.
So, Alison, if we just take a look at the start now and the extension of agricultural stock reliefs, there was a number of important agricultural reliefs that were due to expire at the end of this year, but that's now all changed.
That's right, Frances. So stock relief is a very valuable relief for farmers. It is a deduction from total income. So the relief is 25% right up to 100% for young trained farmers. So the standard relief is at 25%. Increasing to 50% for those in a registered partnership, and full relief of 100% for young trained farmers. So that was due to expire on the 31st of December of this year, but that's now been extended for a further 3 years until 31 December 2027.
And the Minister also broadened the scope of accelerated capital allowances for safety equipment this year too.
That's right, Frances. So there is a 50% accelerated relief allowed for 2 years. So it's 100% relief over 2 years. Generally, capital allowances are available over 8 years where you incur expenditure on plant and machinery. So this is again a very valuable relief for farmers where they incur expenditure on certain farm safety equipment. So the Minister today announced an increase in the expenditure that will qualify for that accelerated relief. So again, details will be included in the finance bill as to what exactly will be included in that over and above what is normally available.
Yeah, and we all know that the devil, as you say, is in the details sometimes when it comes to what's the immediate outcome of the budget. But we know that there's been some quite key announcements in agricultural stamp duty reliefs.
So there has been a number of changes introduced for stamp duty which will benefit farmers. So the Minister in his speech today did recognise the fact that how farmers are organising their businesses has changed in recent years. And so a lot of people are now operating via a corporate entity instead of maybe as an individual. So there will be changes to stamp duty relief and the stamp duty relief for young trained farmers who operate through a corporate entity to extend that relief. And equally, the leased land exemptions will also be changed actually to facilitate people who are operating their farm business through a company as well.
Yeah. And when we talk about agricultural reliefs, like one of the key issues that's been discussed is when you want to hand the family farm on to the next generation and all the issues that has kind of created. And also because, of course, we've all been chatting about the value of land and how it's accelerated in Ireland.
Indeed, Frances. So normally where an individual wants to transfer land on or farm business onto the next generation, we have to think, particularly if it's a lifetime transfer, we have to think of the tax implications for both, say, the parents if it's a transfer to children, and then equally the tax relief available to the children and the implications for them. So I suppose there was 2 key changes in the budget this year that will impact intergenerational transfers of farmland and farm businesses. The first was retirement relief relating to capital gains tax, which will be relevant for the parents on a transfer. So your listeners may be aware that there was some significant changes announced to retirement relief in last year's budget. And the announcement today makes some further tweaks to those changes that will come into effect from 1 January and some very welcome changes. Firstly, last year, the age limit was increased from 66 to 70 before the cap of 3 million for transfers to children would come into effect. And the Minister today confirmed that they will be keeping that age limit increase in place. So that's, I suppose, very welcome for anyone who is in that sort of age 66 to 70 bracket, who will now be able to avail of the higher amount. And then the second is that last year there was a cap of 10 million introduced for any transfers to children where you were aged between 55 and 65. That has been tweaked now in this year's budget, in that there is still the potential for a cap there, but only in the event that the children sell the land within a defined period. So there will be a clawback of the retirement relief claimed by the parents where the child subsequently sells the land within 12 years of receiving the gift, where that land is over €10 million. And as is the case under current rules, any clawback and CGT arising out of that clawback would be payable by the children. If the children retain the farmland for over the 12 years and it's over 10 million, there'll be no clawback. Then on the other side, we look at the children who are receiving a gift of the land. Normally, they would pay CAT on receiving that. And again, as I'm sure a lot of your listeners are aware, there is a very valuable relief called agricultural relief where certain conditions are met. So at a high level, the recipient of the benefit would need to meet the active farmer test when he or she receives that gift. So that would be that 80% of their assets are in agricultural value and that they are actively farming the land. That condition has now been extended in the budget today to provide that the donor, so that's the person making the gift or inheritance, also has to meet the active farmer test, that 6-year test when they're making the gift or inheritance. So the devil will be in the detail in the finance bill, which is due to issue on the 10th of October. But I suppose broadly what the government are trying to do here is to make sure that the relief is restricted to those who are genuinely carrying on a farming business, and to ensure that the recipients of this relief are people who are carrying on a genuine farming trade, as opposed to maybe people who are benefiting from the relief under different circumstances. So it will mean that you'll now have a condition for both the parents and the children. In most cases, obviously it's not always parents that are transferring the land, but both parties satisfying that active farmer test.
Yeah, I think it was interesting because it was obviously Minister Jack Chambers' very first budget in the House, and he did emphasise the fact that agriculture and the agri-food sector is of vital importance to the economy. And I think farmers will be really delighted to have heard that. And I suppose when we talk about farmers, we are always talking about active farmers, and there's been a huge debate really in the run-up to the budget about residential zoned land tax. And there was a reference to that in the budget, but perhaps not as much detail as some people had hoped.
No, and again, we may see further detail in the finance bill, but I think, albeit just, I suppose, a very small reference in the budget today, but a welcome measure nonetheless, I think, for farmers who maybe have land that's zoned residential, but they're using it for another economic purpose, such as farming. They were going to be inadvertently caught by this RZLT tax, whereas now there will be an opportunity for people to seek to rezone that land so that it's zoned for the economic activity that it's actually being carried out on the land, which then hopefully should mean they would fall outside of this residential zoned land tax.
Strong indicators then that there is support there in this budget really for the farming community.
Absolutely, Francis. I think the minister was very clear when he said that, both agriculture and the agri-food sector is of vital importance to our economy, and some of both the changes they brought in and the extensions to some very valuable reliefs for farmers, such as the stock relief, the stamp duty reliefs for young trained farmers, also the increase in accelerated capital allowances for certain farm safety equipment, illustrate, I think, the importance of the role that farmers are playing in our economy, and that they want to, I suppose, help them to run their businesses as efficiently as they can.
And we know a lot of farmers perhaps are second job farmers, or there is also an income coming into the house from the spouse. So generally, the budget today has been quite generous for families.
It has indeed. There's been a number of changes to both income tax credits, standard rate bands and universal social charge. So we've seen an increase in the standard rate band of €2,000 for a single person. So you'd expect a corresponding increase for couples with dual incomes, or again, a smaller increase for married couples at one income. And there's also been an increase in the tax credits. So all of the kind of standard tax credits, so personal allowance, employee tax credit, have also been increased. There's also been an increase in the home carer credit in recognition, I suppose, of the importance of the role that maybe parents who stay at home, or equally people who stay at home to look after dependent relatives, plays in our society. Equally, there has also been a reduction in the universal social charge, probably one of the most significant we've seen, a reduction in the 4% rate down to 3%, and also an increasing in the entry bands, such that we're ensuring that, again, in line also with, I suppose, the increase in the minimum wage, that, you know, the entry point at which people become liable to USC is increases in line with that.
Yeah. And overall, do we think the budget is going to put more money into people's pockets?
I think it will increase each individual's take-home pay. I suppose it will depend on individual circumstances. I suppose everybody should benefit from the increase in the standard rate band, from the increased tax credits, from the reduction in the universal social charge. And then as to each person's individual circumstances as to whether you'll benefit from any of the additional credits, which would obviously have a greater impact. So, there's an increase in the blind tax credit. There's an increase in the home carers credit. We're seeing an increase in the rent credit. It's actually been backdated to last year. So that's going to come into effect for 2024. So therefore, I think, I'm sorry, when I say backdated to last year, I mean last year's budget, because it's good to come into, you can claim it for this tax year. So I suppose if you're somebody who is renting and maybe has a stay-at-home parent in their house, obviously you're good to have a greater increase in the net take-home pay.
And so just going back to farmers, when we look at the incentives that are there now and also the supports, do you think that measure is going to create a different playing field now whenever we see these measures come into play?
I think probably for some of them, like the stock relief, maybe that's been, extended before, I think, in budget. So probably farmers, whilst I think it's a welcome addition, or, the change, or the extension of the release is welcome. Equally, is it going to make a massive impact in reducing farmers' tax liability? Probably not, because they're obviously claiming those reliefs right now. But it does provide certainty, I think, over the next number of years, that they will be able to continue to claim those credits, which obviously is very beneficial. But equally, when you look at, say, the area of accelerated capital allowances amongst farm safety equipment, I think that will be very beneficial to farmers. I suppose there's been we've seen, maybe not a lot, but some stories in the news over the last number of years of accidents in farms, which, have been obviously very tragic. And that does mean, that farmers need to increase the safety measures that they have around their farm land and around the various machineries that they're using. So to be able to offset the costs that they're having to incur in order to make sure that they meet those safety requirements, to be able to do that on an accelerated basis, I think will be helpful. So for the costs that can be claimed as part of those accelerated allowances to be widened, which should hopefully be a benefit to people. If you have a significant, I suppose, upfront capital cost this year, you'll be able to write that cost off over 2 years, as opposed to under the normal capital allowances rules having to write it off over 8 years.
And as you said, there's obviously an eye to the future here, because there has been a deliberate kind of shaping around active farmers.
And I think what the government wants to do here, it would appear, is to really make sure that the recipient of these reliefs are people who are carrying out genuine farming activities. And that the reliefs, particularly, I suppose, the reliefs around intergenerational transfers, are, they're targeted at, I suppose, making the tax efficient transfer of land intergenerationally tax efficient, and making sure that, I suppose, people can do that without having to incur significant tax costs, which could result otherwise in maybe parts of land having to be sold in order to fund those tax liabilities, but to make sure that the recipient of those tax reliefs are the people who it is intended for. And so really it is for active farmers.
And just one other development then in the budget in relation to farmers' flat rate compensation, Alison.
Yeah, so the flat rate addition, as I'm sure your listeners know, is seeking to compensate farmers for irrecoverable input VAT that they incur on costs. That's been slowly decreasing since its high of 5.6% in 2021. And we've seen a sort of a reduction each year So I think this increase will be very welcome. It's a 0.3% increase from 4.8% to 5.1% and will come into effect from 1 January 2025.
And just looking to the future, because one other issue that was raised by the Minister today was on income stability. Now, we know there was no actual measure in the budget, but there are going to be discussions around that in general. And that's reflecting the fact that incomes, particularly in the dairy sector, have really dropped, and it's all to do with income volatility. So that will maybe be something that we'll see a little bit more detail, as you say, coming out on now over the next few months.
Exactly. The Minister did say in his speech today that they are very aware of the income instability, in particular in the dairy sector, but that any sort of measure to support that volatility will require careful consideration, as there's a number of complex issues around the policy and how any sort of relief or measure would operate. So they are working on that within the Department of Agriculture, and one would hope that we will see something announced over the course of time.
There'll be lots more to come in Budget 2025 as the real detail behind the headlines comes out over the next few days and months. But now I'd like to say a special word of thanks to Alison McHugh, tax partner with EY Ireland, for joining me on this edition of AgriFocus. Thanks for listening, and please don't forget to rate, review this podcast on Spotify, Apple Podcasts, or wherever you get your podcasts.